while being slightly fast-paced. The stock market for Opendoor Technologies Inc., trading under the ticker OPEN, is currently reflecting the after-hours close price of $7.48, representing a further decline of -1.19% following the regular session's significant drop on Friday, October 10, 2025. This immediate post-market slide is a critical signal that the bearish sentiment gripping this real estate technology stock has not abated, shattering the expectation held by many retail investors who had recently driven the stock to a powerful 52-week high of $10.87. The reality is that the aggressive profit-taking and institutional skepticism continue to weigh heavily, turning what was a stunning short-squeeze narrative into a volatile descent toward fundamental valuation reality. This stock, infamous for its high beta and susceptibility to retail-driven meme rallies, demands a deeper analysis beyond the surface-level price action. We must dissect whether the recent run-up was a flash of speculative genius or simply a market mirage distracting from deeper structural issues within the iBuying model itself, especially in a persistent high-interest rate environment where traditional real estate transactions are already frozen. The common expectation, especially among the highly engaged retail trading community often found on platforms like Robinhood and engaging in online investing, was that the stock's impressive rebound from its 52-week low of 0.51 earlier this year signaled a permanent turnaround, fueled by a new CEO and hints of a capital-light business model shift. The reality, however, is a market that refuses to support a valuation built on sheer momentum and future potential without tangible, consistent profitability. The volume traded on Friday was substantial, indicating a high level of conviction on both the buy and sell sides, but the closing price of $7.57 and the subsequent after-hours move to $7.48 confirm that the selling pressure prevailed. Institutional activity tells a fascinating and often contradictory story. While firms like Vanguard Group and BlackRock, common names in intelligent portfolio allocations, hold substantial positions, the recent 13F filings revealed mixed activity, significant decreases in position size from major long-term holders, counterbalanced by large new stakes from quantitative trading firms like Jane Street. This whipsaw of institutional sentiment highlights the deep division on Wall Street. Is Opendoor a distressed asset ripe for a turnaround once the housing market stabilizes, or is it an inherently flawed, capital-intensive model that will continue to burn cash? This kind of high-stakes, polarized ownership makes the stock highly susceptible to large swings, a characteristic that draws the attention of aggressive traders but raises severe warnings for those seeking stable returns through more traditional brokers like Fidelity or building a diversified Schwab Intelligent Portfolios position. When we turn to the financial reality, the tension between the narrative and the numbers becomes glaringly apparent. Opendoor's core iBuying business involves buying homes, making light repairs, and reselling them quickly for a small profit margin. This strategy is immensely capital-intensive, requiring billions of dollars in inventory financing, and critically sensitive to sudden shifts in housing market dynamics, such as rising interest rates, a macroeconomic factor constantly in play. For the trailing 12 months, the company continues to post significant net losses, approaching $392 million in 2024, despite generating billions in revenue, $5.15 billion in 2024. The path to profitability is continually pushed out, with many analysts not expecting a sustained positive net income until at least 2027. This disconnect is the crucial reality check for investors. A stock price recently trading near its 52-week high of $10.87 priced in a near-perfect execution of a successful pivot in a favorable housing market. The actual performance, a string of quarterly losses and a gross profit margin that sits precariously low around the 8% mark, suggests that the margin for error is razor thin. The company is actively working to diversify beyond its capital-heavy product by introducing solutions like Cash Plus, a hybrid listing and cash offer product, and expanding its 𝐃𝐈𝐒𝐂𝐋 agent partnership model to pursue asset-light, commission-based revenue streams. These moves are necessary and commendable, seeking to mimic the success of platform-based competitors in the wider tech and real estate space, but they are still in their nascent stages and have yet to prove their scale or profitability potential. The immediate-term catalyst is the upcoming earnings report, slated for release on November 6, 2025. This date looms large, acting as a gravitational pull that will either validate the recent speculative run or pull the valuation back down to earth. Analysts are forecasting an average EPS of -0.07 for the quarter, but the market will be far more focused on two metrics: the pace of inventory liquidation and the resulting contribution margin. Opendoor has been aggressively reducing its inventory of homes, a necessary step to free up capital and reduce holding costs. However, a rushed liquidation can lead to lower sales prices and depressed margins, which directly impact the core unit economics. If the company can demonstrate continued progress in improving its operational efficiency, the ability to buy, renovate, and sell faster and smarter using its proprietary AVM and data-driven insights, it could reignite some institutional interest. Conversely, a miss on the margin front will confirm the bear's narrative that the iBuying model is inherently challenging in a high-rate environment where holding periods are longer and home price appreciation is uncertain. For investors who are self-investing on platforms like SoFi Invest or using a high-level interactive brokers trading platform for granular control, the options market is already pricing in massive volatility around this date, indicating the market's expectation of a wide divergence between the consensus estimate and the actual result. Looking forward, the long-term prognosis is dependent on factors far beyond the company's internal operations. The macro environment, characterized by sticky inflation and high mortgage rates near 7%, has dramatically reduced transaction volumes across the entire real estate sector. Opendoor's success is tied to the liquidity and health of the housing market. A potential pivot in Federal Reserve policy, a Fed pivot, would undoubtedly act as a massive tailwind, instantly reducing borrowing costs and increasing buyer demand, thereby accelerating Opendoor's inventory turnover and improving margins. However, basing an investment thesis on an unpredictable macro event is a speculative gamble, not a grounded analysis. The company's future success rests on its ability to build a robust, diversified platform that generates revenue streams beyond the cyclical, capital-heavy home flipping model. This includes expanding ancillary services like title insurance, mortgage financing, and home warranty offerings, essentially creating an end-to-end digital real estate marketplace. If successful, Opendoor could leverage its significant data moat to become the definitive investing site for real estate transactions, making the cost of customer acquisition, which is currently high, more worthwhile. However, this vision is still years away and competes directly with established players in every one of those service lines. The management's focus on severe cost reduction, with new leadership hinting at dramatically streamlining the employee count from 1,400 to potentially just 200, indicates a sense of urgency to fix the hemorrhaging balance sheet. This aggressive cost-cutting is the most concrete positive development, creating a new and perhaps unexpected reality where the company sacrifices scale for efficiency. The key is whether they can retain the talent and technology that underpins their competitive advantage while implementing such deep cuts. The question of whether to buy, sell, or hold this stock is not a simple one, as the answer heavily depends on whether you are trading the momentum narrative or invest online on the underlying fundamentals. From a fundamental perspective, Wall Street analysts maintain a deeply cautious hold-to-sell consensus, with median price targets significantly lower than the current price. This is largely because the valuation multiple is still extremely high for a perpetually unprofitable, highly cyclical business. For example, a comparison to industry peers like Zillow or even other volatile high-growth tech stocks such as Tesla stock or Nvidia stock shows a disproportionate risk profile given Opendoor's negative earnings. But for the short-term trader, the high short interest and the proven retail enthusiasm for the name mean that volatility remains the primary asset. This is a battleground stock where technical trends and social media sentiment can temporarily override balance sheets and cash flow statements, reminiscent of the early meme days that drew so many to Robinhood stock in the first place. The high beta of 3.60 confirms that this is one of the most volatile names in the market, amplifying both gains and losses. Understanding this dual nature, a fundamentally troubled company with powerful speculative trading mechanics is essential for any serious investor or trader. You must decide if you are comfortable stepping into a position where the trading floor dynamics are more influential than the earnings report. To gauge the market's true risk appetite for this highly volatile sector, comment below how many shares of Opendoor Technologies (OPEN) you currently hold and what price you believe the stock will be trading at immediately after the earnings call. This stock's price movements are a microcosm of the entire speculative tech bubble debate, a fascinating case study for those who follow market structure and high-frequency trading insights often seen on advanced platforms like interactive brokers. The shift to an asset-light model, including the expansion of partnerships and the introduction of a more capital-efficient cash plus option, is Opendoor's necessary attempt to build a more resilient business that can survive future housing cycles. This is the new expectation, a shift from a capital-intensive flipper to a platform provider. If the company can successfully execute this pivot and show a clear, definitive path to sustained positive adjusted EBITDA, the reality could eventually exceed the current skeptical consensus. But for now, the reality of negative earnings, high macro sensitivity, and the lingering threat of a high-rate environment keeps the stock firmly in the high-risk, high-reward category. The stock price of $7.48 at the after-hours close is not a calm valuation. It is a point of profound tension between an inspiring turnaround narrative and a harsh financial reality that has yet to be overcome.